What's up guys, this is Oliver, your Bay Area Realtor, and for today's video we're going to be looking at the current mortgage market and how this may impact your housing affordability in the Bay Area. Quick rundown for this video. First, we're going to review the most recent Mortgage Bankers Association press release. These press releases conduct weekly surveys to break down today's mortgage demand. Second, we'll review today's rates, and lastly, how this will translate to your buying power in the Bay Area. If you guys are new to this channel, my name is Oliver. I'm a realtor in the Bay Area, and I create content on the latest news revolving the real estate and mortgage market nationwide and how that ultimately impacts our beloved Bay Area real estate market. Before we begin, if you enjoy me making these videos, I'd appreciate if you like the video. This will help support my channel and home buyers like yourself who are looking to buy a home in the Bay Area. If you want to stay updated with the Bay Area real estate market, you gotta subscribe to my channel. What are you guys waiting for? With that out of the way, let's cue up the intro. So now we're at my computer screen. I have the Mortgage Bankers Association article for their press release that was just released recently on August 17th, 2022. It is titled Mortgage Applications Decrease in Latest MBA Weekly Survey. We can start off from the top. The Market Composite Index, a measure of mortgage loan application volume, decreased 2.3% on a seasonally adjusted basis from 1 week earlier. On an unadjusted basis, the index decreased 3% compared with the previous week. So what this article is saying is that they are using this index called the Market Composite Index, which basically is a measurement of nationwide home loan applications for almost all loan programs. I have the Trading Economics Mortgage Bankers Association Mortgage Market Index pulled up, and this is what they are referring to. You see here, the Mortgage Bankers Association Mortgage Market Index in the United States fell 2.3% to 273.3 points in the week ending August 12th. You can see from the start of August last year to August now in 2022, there has been a huge decline. The peak was around 750 points and now is at 273 points. So there's a huge decrease in application volume for mortgages. Back to the article. The refinance index has decreased 5% from the previous week and 82% lower than the same week 1 year ago. Now I have also the Trading Economics Mortgage Refinance Index from Mortgage Bankers Association. It says right here, the Mortgage Bankers Association Refinance Index in the United States fell by 5.4% to 627.1 points in the week ending in August 12th. Compared to the previous year, refinancing was down 82%. Wow, 82%. That's a huge number, guys. You see right here in August 2021, it was at a high of almost 3,400, almost 3,500 points, and all the way down after the whole year of federal rate hikes and inflation. The interest rates reacted to it, the lenders reacted to it, and we're all the way now at 627.1 points. So this is extremely low compared to the previous 2 years. Let's look at the 25-year. We haven't reached this kind of refinancing low since the 2000s, like the early 2000s, when I was like a kid. But yeah, 82% is a huge drop in refinancing demand, and it is mainly due to the rise in interest rates over the past few months, partly due to the initial reaction to the federal interest rate hikes and inflation. From my experience, we have a mortgage division in Selective Realty, and we definitely have been struggling to get businesses for refinances. I also know a lot of loan officers who are leaving their jobs because they aren't getting any business. In regards to lenders are also laying off a lot of their staff as well. Here's a great article I have by the Forbes titled Mortgage Layoffs Surge as Rising Rates Crush Lending Activity. They say that mortgage lenders are being hit hard by rising interest rates since applications and refinance applications tend to fall amid increasing rates. Adam DeSantis, Vice President of Communications at the Mortgage Bankers Association, he said, "We saw an exceptional wave of demand for the last 2 years when the Fed cut short-term rates down to zero. The lenders tried to ramp up to meet this demand and they were bringing on new employees." Experts are now forecasting a 35 to 50% drop in mortgage origination this year, from almost $4 trillion in 2021 to as low as $2 trillion in 2022. Most of the drop is due to a decrease in refinancing, which is expected to fall to $730 billion in 2022 from $2.3 trillion in 2021. Man, that's a big cut, according to estimates from the Mortgage Bankers Association. Now let's look at the layoffs. Wells Fargo laid off at least 114 employees in its mortgage lending team this year, following a 33% drop in first quarter revenue to less than $1.5 billion, down from $2.2 billion a year ago. JP Morgan announced its most recent round of layoffs in its home lending department this Wednesday, affecting more than 1,000 employees. Layoffs are often much worse at non-bank lenders, where a less diversified business makes the companies more susceptible to fluctuations in mortgage rates. They are also more likely to serve first-time homebuyers, who are the first to get pushed out of the housing when rates rise. Non-bank lenders also rely more heavily on refi mortgages, which make up 63% of all mortgages last year and are expected to continue to fall this year. Let's look at the non-bank lenders' layoffs. Online mortgage lender Better.com has let go of the employees in the industry. Online mortgage lender Better.com has let go of the most employees in the industry, totaling more than 3,900 workers over 3 rounds of layoffs starting in December of last year. According to Housing Wire, other mortgage lenders conducting layoffs in 2022 include New Residential Investment Corp. 386, Owning Group 189, PennyMac Financial Services 474 positions, Inner First Mortgage Company 491 workers, Mr. Cooper 670, Stearns Lending 348, and dozens of other small lenders throughout the country have also let employees go in the recent months. Even brokerages like Redfin said in a written statement after announcing the brokerage would be laying off 470 employees, or about 8% of its workforce. Zillow.com, real estate marketplace, announced layoffs of 2,000 employees, 25% of the company, in late 2021. The layoffs were largely the result of Zillow shutting down its home buying program. So we're seeing a lot of layoffs in the industry for real estate and also mortgages. And that is mainly due to the rise in interest rates, inflation, and just not having enough demand for mortgage applications and real estate in general. Back to the article, the unadjusted purchase index decreased 2% compared with the previous week and was 18% lower than the same week 1 year ago. We have the Mortgage Bankers Association purchase index. Applications for a mortgage to purchase a home dropped 0.8% for the week ended in August 12th and were 18% lower than the same week 1 year ago. If we look at 1 year, this is what the chart looks like. We're in August right now, and it's currently at around 203 points, and it was all the way last year at 260. What this means is that less people are applying for mortgages to purchase a home, and as you can see from this chart, it has dropped 18% from exactly 1 year ago. The data here supports the narrative that buyer demand is dwindling. This is important to pay attention to in the coming months ahead to see where our buying demand is at. In my August Santa Clara County market update video, home sales in July dropped 30% since June, and there's an increasing amount of unsold inventory. So we're definitely seeing less buyer demand on a local level. Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting, he had something to say here. Mortgage application activity was lower last week, with overall applications declining over 2% to their lowest level since 2000. Home purchase applications continue to be held down by rapidly drying up demand, as high mortgage rates, challenging affordability, and a gloomier outlook of the economy kept buyers on the sidelines. However, if home price growth slows more significantly and mortgage rates move lower, we might see some purchase activity return later in the year. Now let's look at the mortgage rates for your basic loan programs. Here I have on selectiverealty.com, if you go to mortgages and mortgage loans, you'll be directed to this page. And if you scroll down, you get to see the current rates right now for your basic loan programs. For the 30-year conforming fixed, we have 5.741%. 30-year jumbo, we have 5.529%. 30-year FHA, 5.571. 30-year VA, 5.336. 30-year USDA, 5.565. And 15-year conforming, 5.128%. Let's look at the rates for a whole year. Right now, these are our rates that I just mentioned. This is a slightly lower than the peak that was at its highest during June 14th to June 15th, when everything was almost 6%. I mean, you got the 30-year conforming at 6% over here. But all the way down exactly 1 year ago, everything was at least 2 points lower in terms of interest. We're slightly lower than the peak, but we've been having some decreases over the past few weeks. Alright guys, so we're going to review how the current interest rates affect your buying power in the Bay Area. We're going to be looking at mostly the 30-year jumbo loan, especially for single-family homes, because the Bay Area housing market for single-family homes, you're looking at higher prices generally to the rest of the nation. Usually the jumbo loan amounts can be anything above $970, $801. Let's look at our mortgage calculator. It's also a useful tool that you can find through go through resources, and then you hover down to mortgage calculators. We're gonna go conventional 30-year. If you didn't watch my Santa Clara County August market update video, the current median sales price in Santa Clara County for a single family home is $1.7 million. If you were to put a 20% down payment, this is on $340,000. Let's increase the interest rate to what we saw over here, which is 5.529%. You can type it in here. Okay, so this is the monthly payments breakdown. Your principal and interest will be $7,746.69. I want you guys to write that down, okay? Taxes and insurance, $1,700. Hazard insurance, $779.17. Okay, so this is right now. This is how much you're going to be paying, which is a total of $10,225.86. Now, if we look at what the rate was exactly 1 year ago, we're going to see how much this has affected your buying power. So let's look at almost 1 year ago. This is 2.996, August 25th of 2021. So we toggle back 2.996%. Your principal and interest is $5,730. So write that down, and your total payment is going to be $8,210. So this is nearly a $2,000 difference in your monthly payment in just a year, which is affecting your buying power if you're looking to buy a home in Santa Clara County. But let's look at more examples. So this is a condo in South San Francisco, and the asking price is $798,000. If we plug that in, let's plug it in right now. $798,000. If we were to put a 20% down payment, that's $159,600. So this wouldn't be a jumbo loan. This would be the difference between $798,000, which is the property price, minus your down payment of $159,600, and that would be $638,400, which falls under the conforming loan amount. So if we look over here, the conforming loan currently is at 5.741%. So this is $4,885. So the principal and interest for this property, if you were to purchase it with 20% down, is $3,721.88. Taxes will be $798. This probably doesn't include HOA, so it's slightly off. Hazard insurance $365. Your payment's going to be around $4,885. Now let's look at what the conforming amount was 1 year ago. Conforming loan amount 1 year ago was 3.07%. So now if you set the interest rate to 3.07%, your principal and interest is $2,715, and your total payments around $3,879. So with the 2-point increase, you're paying $1,000 more from approximately 1 year ago for this South San Francisco condo. Based on what you saw, Rates are keeping price-conscious home buyers on the sidelines as record home prices and affordability are affecting buyer demand. If you're looking to purchase a home in the Bay Area, now is a good time to take advantage of the thin competition to negotiate better deals for yourself. If you're looking for an expert realtor in the Bay Area, you don't need to look any further. You can contact me for a buyer consultation, and I'll help guide you through the home buying process to get that home that you're looking for. So I hope this video gave you some perspective on today's mortgage market. I recommend using our mortgage calculator on our website to get a better understanding of how much it costs to have a home in the Bay Area. If you found this video informative, please like this video and subscribe. And don't forget to hit that bell icon to stay updated on everything real estate in the Bay Area.